everyone, and welcome to the Amber Data Derivatives podcast. I'm here with Brent Kochuba, who is the founder of SpotGamma, which is an options analytics firm that specializes in a lot of tools in the traditional finance space. Brent, how are you?
I'm doing really well. Thank you very much for having me on today.
Yeah, absolutely. I mean, very excited to have you on. I've seen SpotGamma for a long time. We've chatted in the background for a while now, so it's nice to finally get you on and kind of go over your background and everything you're building over at SpotGamma. I
Well, thanks, and kudos to you for Amber Data. It's an incredible platform, and it's inspired a lot of ideas for me on the equity option side. So,
Oh, I love it. Well, thanks, Brent. So I thought maybe we could start with a little bit about your background. I mean, you have a pretty substantial, serious background in the option space. You worked at quite a few firms, also a family office. Maybe we could just start there for anyone who's new to SpotGamma or new to getting to know you.
yeah. So out of school, I basically went to Bank of America around 2002, and I was first in program trading, which is trading baskets of stocks.
Mm,
And so our clients were pension funds and firms like that, and we would take these big orders. We'd get Excel sheets with all the shares they wanted to buy or sell, and then we would use what was then the kind of start of algorithms. So VWAPing orders, for example, was kind of a
interesting.
big thing. And I did some block share trading, some stuff like that. That desk launched an electronic options trading algorithm, I guess I would call that, and I chose to kind of follow that path, and that's where I got into the option space, which brought me to Credit Suisse. So they have a group called the Advanced Execution Services, and that is all about electronic trading in the option space. So I worked at Credit Suisse for a couple of years. And then from there, went to Wolverine. Wolverine's known as one of the largest market makers on the street. I was a broker there and did that for a few years. And then I went to work for one of my clients who wanted to launch a new hedge fund. And he traded S&P 500 options. And so that's where I really got to sort of go from being, a broker and sort of sell side view of things into, modeling options a little more formally, I guess I would say, and started to see kind of where the rubber meets the road in terms of the impact of trading and modeling positions and things like that.
Oh, yeah, that's fascinating. I'd like to jump in just a couple quick more details there. So, at Credit Suisse, you mentioned sort of the electronic options trading sort of execution system. What was the big differentiator there? Like, were you able to for once, sweep the whole ask side or bid side, or like what does that look like?
Yeah, I mean that was kind of like the funny thing about it is that it was like the first or one of the first iterations of being able to like electronically sweep an order, and so it wasn't at the time as interesting necessarily as pricing up some a derivative trade. But the thing that people were so interested about was just the fact that you could do it. It was sort of like, hey, I have
Mm,
the internet at my house. Like, oh, I can electronically like sweep orders. And so the cool thing for me about that was I could really get into, the exchange mechanisms and how orders are routed. And then that leads you into how electronic market making works and understanding how they're hedging because who's buying and selling all these electronic orders that we're sweeping, for example. So, that was a real that opened a lot of different avenues and just a whole another level of understanding, down to the actual like exchange level again of what's happening with options orders and options routing.
wow, that's fantastic. And then there's another kind of component that you mentioned that was very interesting. So you went to go work for your client trading S&P future options or S&P options, uh,
Index options, yeah.
index options, and then at Bank of America, you basically did like aggregates or like kind of ETF like execution of multiple
Yeah.
stocks. I guess my question there is that if I'm trading SPX options or S&P options, does the underlying components, like all the underlying equities that are the composite of the S&P options, does that positioning affect the positioning of the S&P options? Like, how are those related? Because it looks like you had experience kind of in both. If we take Bank of America to your client.
Yeah. I mean the so a lot of his understanding how orders get down to various exchanges, and then when you're trading anything, a lot of it is about liquidity and supply and demand and transaction costs, right? Particularly when you're talking about institutional trading. So when we're sitting here as a retail trader, it's sort of a foregone conclusion that I can get off a 10 lot order in probably any U.S. listed instrument in the market's probably 10 cents wide maybe, and I mean, it's pretty small in the option space, right? At worst, a lot of times it trades at a penny, and it's no problem. But if you're going to trade 10,000 contracts, the liquidity's not there, and you got to price that in, and you got to know what your client is doing, and you got to know what the impact of the market impact is on the market. So a lot of times with the pension funds, they could have 6, 7, 8 million shares to trade. I think that was one of my biggest orders, was a Yahoo block. And, I'm sitting there and I'm just buying this stock because the client wants to close out their position. And so, we're buying it so we could sell it to them, and we're moving the stock price up. And it's this whole, it becomes this complex web of, can I lay some shares off here? Can I do this? Like extend some of the price over the rest of the day, or trade it over the rest of the day. So there's a lot of dynamics that are involved when you're a broker trying to get in and out of these big positions. And so when you understand that impact, the stock impact, and then you start to monitor options hedging flows, it's easier to tie together, hey, market makers need to buy a couple million shares of NVIDIA, for example, and what is that likely to do to NVIDIA itself? And then what is NVIDIA impact? What does that do to the rest of the market? And I bring up NVIDIA specifically here because, we did a whole presentation that just came out. It's called the OpEx Effect podcast. And we break down that NVIDIA was, for example, on September 11th, this past Wednesday, the S&P was up 1%. Well, 44 basis points of that was NVIDIA alone, just the return of NVIDIA, right? And then NVIDIA is part of 528 different ETFs. So, there's this there's this chain reactions, like the butterfly effect, right? When people start aggressively buying NVIDIA calls, and that has to get hedged with stock, and the knock-on effects of that as it impacts the S&P and all the other linked ETFs.
Wow, that's fascinating. That'll get us really into some interesting tools that you guys provide at SpotGamma. But before we just jump into that, when you were working at the trading S&P options, did you trade through like events such as Volmageddon that we had in 2018? Like, what did that look like?
Yeah, so I had a master class in convexity, I would say. So I was working for a portfolio manager for a month, and the strategy was generally selling. Just to sort of paraphrase it in the easiest possible sense, like counter spreads. So we would be selling, shorter dated, 10% out of the money options, 2 months out, and then buying, longer dated, like 2 years out. Deep out of the money puts as like hedge, as a general way the portfolio is structured. And the idea that when the PM said that when vol starts to lift in a risk off event, those longer dated vol 2 years out should really pick up asymmetrically to your shorter dated contracts, right? That's the convexity component. And so the strategy is based around this math that essentially, like, when you have risk off, the 2-year option is going to make a lot more money than the shorter dated option will lose, right? Because you're short the shorter dated option. So that's critical to understand, because we started trading a month before August of 2015, and that was one of the biggest, at the time, one of the biggest VIX spikes and market crashes in history, when there was Chinese credit issues, and the S&P really fell apart, and the VIX went up around 50, and all of a sudden, the spreads widen out in what you're trading, and we don't get the same tail hedge that we thought we would get in that portfolio. And so then you suddenly start to have these margin issues, and you're trying to wade through, how can I hedge this, and what can we do, and working with prime brokers. And what was most interesting about this was, number one, understanding exactly how the market can move, and in terms of how a volatility surface can really shift. And it was fascinating to see that break down. And in that case, it didn't really go our way, and I watched these positions move against us, and that wasn't a pleasant feeling. But the other thing is that we figured out how to hedge the portfolio, but the prime broker in that situation, with the credit risks in the market, they did not want volatility strategies like we had. They just didn't want them on anymore, right? And so even though you could generate a positive return out of that risk-off environment, they did not want that exposure. And that was a big lesson for me, in that there are these times where the bank is out to save itself, the prime is out to save itself, and it needs to de-risk. And so it doesn't matter what your profile looks like, or what your return looks like. They don't want this volatility exposure on, right? You're done. And that was a really fascinating, kind of eye-opening experience. And I think about that a lot when you have, like, the yen carry trade that allegedly broke, a couple of weeks ago. and I can sort of know what it looks like to sit in that seat. And maybe you're getting taps on the shoulder from either your boss at your hedge fund, or it could become from your clearing broker that's saying, look, you guys are got this, yen carry trade component that we just don't want on our books
Mm-hmm.
anymore. Like, you got to close that up. You got to get out of here. And what are the effects of that? It's nice. It's oftentimes interesting to think through that.
Yeah, that's a really interesting component. Like when the market is the most investable, if the credit market's broken, you don't have sort of the ability to take the other side. You can see that with all sorts of markets. The real estate market crashes in 2008, but how can you get the
Yeah.
mortgage to buy the house? It's
Yeah,
like
yeah, right,
that's
right.
very
And as a
interesting.
retail investor, we generally don't have that problem, right? Because no
Hmm.
one's going to care about our 10 lot or whatever we may have on. But when you're talking about millions of dollars worth of exposure, and then you have derivatives which have even more exposure, then that becomes it's a game within a game a lot of times.
Yeah, fascinating. Cool. So then, about 5 years ago, you founded SpotGamma. Can you maybe just walk us through sort of how that came about?
Yeah. So I had spent after that August 2015 exercise, I had spent a lot more time modeling the S&P 500 for this family office and had built some pretty interesting portfolios. And that family office was big in real estate, and the pandemic hit, and kind of everything shut down. And so I had these options models that I had worked on, for several years, and I had really been able to see how the options positions in the SPX could impact the S&P itself, which kind of going into the family office experience, I wasn't necessarily convinced that that link was there. Like, yes, you see a trade go up and the market reacts really quickly to that, but this idea of gamma hedging being a persistent flow, impactful flow in the market, I really didn't experience that until kind of the late teens, based on this modeling I was doing. And so when the pandemic hit, I found myself out of a job, unfortunately, and no one was doing interviews then, right? Because
Hmm.
it was literally when the country shut down. And so I put the models up online, and someone said, "Hey, can I pay for daily updates of this?" And I said, "Oh, well, sure." And so that was kind of the birth of writing daily research and offering basic gamma curves in the S&P 500. And those gamma curves basically said, "Here's where dealers have to sell stock, and here's where dealers have to buy stock." And that was kind of the initiation, or that's where Spot Gamma really got started back in January of 2020. So 4 or 5 years ago.
Yeah, that's fantastic. And so, just for anyone who's new to Spot Gamma, can you just give us kind of like just a brief overview of where what's the product today and what the company looks like today?
Yeah, absolutely. So I've written a daily research note every day since January 2020. Have never missed a day, which is something I kind of pride myself on. So that's the foundation of what we do. And then, over the years, we've built up a lot of data tools. We offer a bunch of live views into different hedging flows. In fact, we're launching a new product called Trace, which is a proprietary positioning system. So rather than just looking at open interest and saying, hey, like this is just open interest, we now track whether we think dealers and market makers are short certain calls and puts versus long in other parts of the surface, so to speak, or other different tenors. So that tool is called Trace. We launched that next week. That's the 24th. So we're really excited about that. And then we do single stock positioning as well. So everything that we do is around analyzing how the options market is driving the underlying, and that's really the core of what we're trying to do over here. And I think what's interesting too is now a lot of people kind of take this for granted, right? But in 2020, most of my time was spent convincing people that there was this link between options flows and the underlying.
Oh, interesting.
And in late 2020, mid to 2020, some more people started to warm up to this idea because of the crazy trades that were going on in Tesla. But then it was meme mania in January of 2021, where suddenly everybody is an options expert, and everyone's like, "Oh yeah, of course, options flows, move stocks," which is kind of funny. But options volumes have really only grown since then, and so more of what we do now is try to offer best-in-class tools to describe these flows, a little more so than prove that there is a link between the flows themselves and the underlying stock.
Yeah, that's fantastic. Really interesting point about sort of Wall Street bets, retail investors, trading a lot of one lot options, but in large volumes, one lot trades becoming a bigger percentage of the total options trades. How have you viewed that impact on the market, having sort of this new retail interest in options trading?
I think the options market. I mean, the market makers in the options space, of which there are only about maybe five very large firms. I mean, there are just a few firms that are the big core market makers. Citadel, Wolverine, Susquehanna. Those are the names, and so they're incredibly sophisticated, incredibly smart. And I bring that up because in 2021, I think that the retail public got the jump on the market makers. Right? No one expected the kinds of things that were happening. No one had experienced that environment anymore, and so now I think things adjust a lot faster to these retail flare-ups, right? Like everyone, people still get together and try to game a certain stock, or Roaring Kitty shows himself every once in a while. But the prices in the options market adjust, I think, very quickly to those types of moves and types of events. And so, the meme factor is still there, and there are still effects, but the effects are different, I think. Like you see implied vols basically jump a lot faster, I think, than they used to. Which still presents a lot of interesting trading opportunities for someone like myself, to trade. But it's not so much like, hey, I'm just going to get on the bus and try to ride the retail name because they're all going to jack this thing up, right? Like what tends to happen is the retail, it starts to percolate that all these people are buying calls because Roaring Kitty's going on a webinar next week. But instead of trying to ride that, you more so say like, well, I'm going to sell, like I'm going to sell call spread against or whatever. So you can still interact with that as a trader, but the market definitely adjusted to it. The thing that is more impactful now, at least on an ongoing basis, is short-dated options. So 0 DTEs in the S&P 500, and then whatever the next expiration is for the biggest stocks, which is like NVIDIA, Apple, et cetera. There is a lot of what I think is just high-frequency momentum type trading. So I don't think that these are necessarily... They're almost like relative volatility trades, I think, that are going on. Like the reason I pause is because I don't think they're vol traders. I think they're almost more like quantitative high frequency trades happening that are more interested in the leverage they're getting with options as opposed to, the volatility aspects of it, if that makes sense. And I think that is really dominating the flows, and it causes a lot of large, rapid movement in the S&P 500 as well as single stocks. We saw that very recently, for example, on September 11th. Today is the FOMC, obviously, and there's going to be a bunch of 0 DT positions that are going to move the market as well, and you see it on a daily basis. And now they're talking about launching single stock options 0 DTE. So every day there will be like an NVIDIA expiration. I don't think that's been officially announced. You just start to see it in the media and stuff a little bit that this is an idea. And there's a lot of there's going to be a lot of impacts on that, and so. I know I'm kind of being long-winded here, but the other thing I would say is that when you see risk-off environments and the focus shifts to wanting to own a volatility hedge, meaning something longer than today, like I need to buy like 1 month or 6 month out, like S&P puts, for example, you see that 0 DTE liquidity evaporate. And so you have this illusion where there's a lot of liquidity in a normal market because there's all this 0 DTE flow. But the minute that risk pops its head up, like in early August, for example, then suddenly like that 0 DTE flow goes away, and the underlying just sort of like falls into like this abyss, and I think it makes things much jumpier than they used to be.
That's really interesting. So, I mean, both kind of components that you just covered, the retail flow and the 0 DTE, create sort of the retail one increases the vol of vol. So if retail kind of piles in, vol quickly spikes and then probably quickly spikes back down because people just get right back out. So that's a very interesting component. And then the jumpiness of the liquidity, which is like a smoke and mirrors illusion when everything is calm, that there's all this depth to the 0 DTEs. The second that you need them, everything goes away. So now you can have sort of a jumpiness in the liquidity component. That's fascinating because obviously those types of things are usually learned the hard way. So if you're not aware,
and so we saw early September, we saw more of these kind of, I call them correlation spasms, basically because right now there's like the NVIDIA trade. That is the only long equity story there is. It's like, can AI and the chip sector save us from, recessions or whatever? And so there's a chase constantly in those names. And so NVIDIA is really, this incredibly important stock to the market. And I almost think that you can, buy a lot of short dated, 0 DTE type calls in NVIDIA and just move the entire equity complex, by doing that. And you talk about liquidity, and with NVIDIA specifically, if you do the math on, or just add up the number of call options traded so far in September, NVIDIA, as of 2 days ago, had traded 25 million calls. And to put that into context, the next highest product in the US options market is Spiders, which traded 16 million calls.
Wow.
So 25 versus 15. And then if you go to Tesla, which is the next biggest thing, it's 8 million. So NVIDIA is trading like 2x the next to 3x the next largest stock in terms of options volumes. And most of that, again, 45 to 50% of that is short dated in nature, meaning next expiration. So you have that dynamic, and then you have all of these ETFs which demand the NVIDIA shares, right? So if you talk about free float is like 24, I think it's 24 billion shares for NVIDIA. 66% of that is held by institutions, so these ETFs and things like that, large hedge funds that hold the shares. And then you have buybacks as well, which reduces that, the share float. So the point here is that the tradable float in NVIDIA, I think, is probably like half of what people really think it is. And then you get options hedging flows,
Right.
which in a lot of ways are like a margin call. It's like, I can't sit here and wait to like take my time to like buy stock against these short calls. Like, I got to buy stock now as a market maker, right? Like, you don't have the luxury of time in a lot of moments. So, like if NVIDIA is up 8%, I can't just sit there and be like, well, I'm going to wait to see what happens here. It's like, no, I got to go buy stock, and I'm buying stock into this very illiquid environment. I'm a forced trader in some ways, which just pushes the price up. It makes volatility, of the underlying increase.
Wow, so that's fascinating. So just to recap, so if we take the NVIDIA component of sort of the S&P 500 exposure, NVIDIA itself is like can move the overall markets, kind of like what we saw on September 11th. But then if we look at the tradable float, so for listeners, the smaller the tradable float, the less money it takes to move NVIDIA stock. If there was only one share, it'd take $100 to make it go from 100 to 200. So
Yep.
basically, there's a small float, and then you overlay zero DTE options or a lot of options exposure, and then it creates forced buyers from market making hedging activities to delta hedge. So now you have like three effects: small float, zero DTE or short dated option exposure, and the impact to the overall market. So it seems like there's probably some sort of interesting opportunities where positioning might be so extended in NVIDIA, but then in the S&P 500 or SPY or something else that's closely related, there's probably like a trade to be done there by looking at
Yeah.
NVIDIA, something like that. That's
Yeah.
fascinating. So
Yeah, and I think what a lot of that is traders will get long vol in Nvidia and short vol in S&P. And if you look at like SIBO has this metric called the correlation, 1 month correlation, COR1M is the ticker for that, and it shows you what the implied vol is of Nvidia, or it shows you the implied vol of the top 50 stocks in the S&P index versus the vol of the index itself. And for example, in early July, when the market was near its high, we saw single stock vol be higher versus index vol. It was, I believe, it was the highest that it had ever been. The spread between those two was the highest it's ever been. So you can see the impact of these trades and these dynamics that really rear their head up. And then the other thing that you'll see is when S&P, like in September, it'll go down 5% over a couple of days, but then NVIDIA will be like down 20% over that same time frame, right? So you really get these
Right.
exacerbated moves, I think, due to this kind of a lot of it is a liquidity dynamic that is just exacerbated by zero DT options.
Oh, that's really interesting. So earlier on, you mentioned your new product, Trace. So in the notes here, in the show notes, you'll be able to get a link directly for the September 24th webinar. But maybe you could just give us a quick overview, Brent, of the new product, Trace.
Yes, so Trace we're really excited about because we're launching a proprietary positioning system. So in the past, we sort of would model where we think, maybe dealers and market makers are short, long calls and puts, but now we have a more data-backed way of doing that, and the new model is really unveiling a lot of interesting things. So, is there really a gamma squeeze in this name because dealers are short calls? Before we'd look at kind of the vol surface and try to, extrapolate some ideas there, but now we can look at this proprietary information we have and really get an extra piece of information that said, yeah, look, everyone is short, NVIDIA calls, or everyone is short, our dealers are short GameStop calls. And so that's an important place where this product starts. And then what we're doing is every single trade that takes place, we're updating that positioning model, and then we're forecasting what hedging flows will take place over a given range of prices and as time changes throughout the day. So what you end up getting is this heat map, which shows you the dealer hedging pressures as they unfold through the day. And it's a really effective way to understand exactly, different scenarios. Okay, if the market rallies, how will dealers react? If the market sells off, how will dealers react? And that we think gives people an extra edge in trading.
Yeah, yeah, absolutely. And would you say that most of the customers of SpotGamma are like retail or institutional, or is it a mix?
Yeah, I mean, it's a mix. There's obviously just way more retail people in the world than there
Mhm.
are hedge funds. And so, it's definitely a mix. I think in terms of number of individual subscribers, probably retail is more. It's a big pro-tail component, which is, we call them professional retail traders who
Mhm.
are, they're a little more sophisticated in what they're doing. But there's a tons of hedge funds. We have a Bloomberg app, for example, and, they can access there. There's a lot of buy side and sell side that are looking at these positions. And some of them are there to actually because they're options traders, and others are there, as like traders who need to know what's happening because their PM just yells at them, say, "Hey, I don't understand, why stock XYZ went down." And then you look at the options tools and you see, oh, well, there's a big, put print, and that's why, those hedging flows probably knocked it
Mm.
down, and that can explain a lot of unusual movements.
Oh, that's fantastic. And just kind of just wrapping up here. So, I've been seeing Spot Gamma in a lot of like media and stuff like that. So you guys have done a really good job, putting yourselves out there. Do you guys also have like a YouTube channel or like educational content or like a podcast or anything like that?
Yeah, we do. So if you go to YouTube/SpotGamma, youtube.com/SpotGamma, we have a lot of videos there. There's some educational videos on there, kind of Gamma 101 type things. And then we put out a lot of just our market views as recorded content. I do a monthly OpEx podcast that just came out today where we talk about this NVIDIA example that we're going through in the liquidity in NVIDIA being poor. That's called the OpEx effect. So if you go into YouTube and just type that in, you'll find that. And then there's a lot of information on our website as well, educational materials and different analysis that we do.
Very cool. And then kind of just thinking future roadmap, is Spot Gamma essentially going to be always focused on purely data analytics, or do you guys plan to eventually like allow execution capabilities or anything like that, or kind of what's the long-term vision?
Yeah, as far as execution capabilities, I don't see that in the horizon for the main reason that I don't want to deal with the compliance aspects of that
Yeah.
business. That's tough. And I think you have to we'd have to probably raise a bunch of capital just to get through the legal and compliance aspects of that. And you never say never, but that would be a much more complicated topic for us. Um, I do think that we want to get into pricing and risk. So, giving the ability for traders to, assess whether, what types of trades they're putting on, looking for new trade ideas, sourcing, idea generation is essentially, I think, kind of the next frontier for us in that respect. There are some interesting international opportunities opening up, with volumes like in India, for example, are really large. European zero DTs are trading now some of the European products. And then obviously, we always watch the crypto market. What's interesting about the crypto market is it's covered so very well by groups like yourself. And, it's not quite as second nature to me, whereas I really grew up in the equity, slash equity option space. So it's kind of second nature to me. But, there's a lot of places that we can take it. All that being said, the block and tackling of the data and the flow that we're watching now is a tremendous exercise. And so,
Hmm.
we got our hands full.
Yeah, I know how that goes. Awesome. Well, kind of wrapping up here. So we usually like to finish with kind of three sort of personal questions or a little bit more tangential questions. So the first one is, if anyone wanted a career like yours, what would you give them as a piece of advice?
Yeah, it's a great question, and I think the thing is that you have to find ways to add values in a niche market that is underserved. So, I gained this options knowledge and started to look at a very unique part of the options market, options dealer hedging flows, which in 2020 was something that very, very few people were talking about. And that really helped to get a lot of eyeballs on SpotGamma early. And that's, I think, why we've been able to be such a success. if you tried to start a business now talking about options hedging flows, I think it's much harder to get attention just because it's a much, louder room, right?
Hmm.
So, finding something that interests you, but picking a niche that you think is underserved and likely to garner attention is I think just really critical to starting a business like this. So, if you're in the crypto market, are you covering certain aspects that other people aren't covering? Um, and serving the community to get eyeballs in ways that other people aren't is I think really critical. If you're out there telling people why they should buy Bitcoin right now, you got a hard time going to get attention on that.
Yeah, that makes a lot of sense. Uh, what do you like to do for fun outside of work?
I've been trying to take up fly fishing, which is going slow,
Oh,
but that's kind of my next that's my next big thing. Becoming an old fisherman, I guess, is the thing. But it gets me outside. I hope I can travel around that a little bit. And I'm finding that to be a fascinating exercise because you have to learn how to actually cast the rod, and then also like you have to learn all about fish. So there's like this two-part component
mm.
to it. Whereas like shooting a basketball, it's like, okay, great, I shoot the ball, I'm good. But it's really almost like a double. It's like a twin education of learning about fish and then also learning to use a rod and reel.
Oh, wow, that's fantastic. I'm out here in Idaho right now, and
I was gonna say, I don't
fly,
know, we got to become friends so I can so
people love fly fishing out here. I haven't done it myself, but it definitely looks like a hard sport.
Yeah, yeah. There's the serenity of being out in the woods by yourself, and that whole piece seems really attractive. But there's a long way between where I'm at now and there. But that's currently what I'm trying to undertake.
Oh, that's fantastic. And then the last question is, throughout your career, have you had any favorite trading books that you would recommend to listeners?
I have a lot of them. The one that I actually just cracked open, which I've had for a couple of years, is called Second Leg Down by Harry Krishnan, who is he's a hedge fund manager and a strategist. And the book is basically about the type of trades that you put on in an elevated vol environment. So specifically, hey, we had the first drawdown and vol's kind of elevated. Like, what do I do now? Like, how do I roll exposure down and out if I want to maintain downside exposure, and how do I play upside? And operating in that elevated vol environment, I recently started rereading that book. We got the VIX here at 17, 18 ahead of the Fed, and so those ideas are interesting. There's a lot of cool trade structures he set up in there. A lot of theory and trade structure that's presented in a very digestible way, right? Some of these books are, if you don't have a PhD, it's hard to track some of what they're saying.
Mm.
But I find his book to be very useful and very accessible, which is hard to find. Both of those in options books.
Oh yeah, that sounds like a great book. Well, Brent, thank you so much for coming on. Super interesting, fascinating developments in the vol markets and in the equity space. Very insightful. Thank you.
I can't thank you enough, and hope to be back soon.
Absolutely. And everyone who tuned in, thank you. And we'll see you next time.